Hi, everyone. Thank you for joining our webinar today. I'm Glennis McClure, Extension Educator and Farm and Ranch Management Analyst with the Center for Ag Profitability at the University of Nebraska-Lincoln. Remember that you can find archives of our past webinars, as well as the schedule of the upcoming webinars on our Thursday series on our website at thecap.unl.edu. As farmers and ranchers prepare to close out another tax year, there are many considerations to keep in mind ahead of filing for the year. Today's webinar will cover many of those tax considerations, including crop insurance, deferral options for livestock sales, changes to the Nebraska State Property Tax Credit, and the pass-through entity and others. So we're always glad to have Tina Barrett as our presenter. She's the director of the Nebraska Farm Business Incorporated. Nebraska Farm Business, Inc. started in 1976 as part of Nebraska Extension. Today, they work with hundreds of farmers and ranchers across the state, providing financial consulting services, including financial analysis, business planning, tax preparation, and more. So Tina, thanks for joining us today, and I'll turn it over to you.
Yep, thanks for having me. All right, let's get started with everybody's favorite topic is taxes. But just to make sure, Glennis did a good job of explaining what we do, so I won't spend a whole lot of time here. But did want to talk, we don't have a whole lot of new tax laws, which I'm always thankful for. But we have some things that are expiring that we need to keep on our radar. And then I just have some other general things that I think it's important that we pay attention to over the next few months. So first, the new thing is we heard all about the special session and the LB 34 that was just passed here a few weeks ago. And I think it's important to talk about. It's getting some publicity now, but what part of that that bill that was passed eliminated the K-12 tax credit program that we've been used to for the last 4 years. It has made that property tax credit automatic and upfront, which is really nice in the fact that we don't have to pay our property taxes and then get a credit back later on the tax return. And yeah, it's been a cumbersome process anyway to have to go through and list each property and how much tax was paid on that. And if there's a delay in the counties getting that reported to the state and being able to file. And so this is a good step. The downside is there's going to be some changes to your 24 tax return that we need to be prepared for. So it immediately ended the credit program. So any taxes that were paid in 24, which would have been our 23 taxes, there will be no credit for. You're going to get the credit on 24's taxes that'll be paid in 25 by having a reduced amount that you pay the county. But there is going to be that limbo year for the tax, for basically any taxes that would have been paid in 24 that there will be no credit or no reduction on. And so that's just part of how this was funded and paid for. There was a second credit added 2 years ago that refunded a portion of the community college tax. That tax was a separate authorization, and that didn't get removed in the property tax reform. So that they have moved it to 100% of what you pay, they're going to give you back. So we're still going to have to go through the same process of filing the form PTC on your Nebraska tax return to get the community college portion. So your tax preparer is still going to need to know every property that you paid taxes on and how much you paid. And we'll have to go through that same system with the state just to collect the very small portion of this. So depending on how many properties you have and how much tax you've paid, this may not be worth the time that it's going to take to actually prepare the form. You know, we definitely eliminated the large part of it, but maybe that's going to be something that can be fixed in the future. But again, since the legislature won't be back until January and we'll be ready to file tax returns by then, I don't expect anything that could be done for the 24 year. But maybe moving forward into 25, that's something that they could fix. The other thing that I think is important to think about this is a lot of taxpayers were using that property tax credit to reduce their estimated tax payments. So maybe, not qualified farmers, but anybody that has a corporation, certainly wage earners, anybody like that, that credit has been able to be used to calculate estimated tax payments. So the Department of Revenue has already updated their form so that they're going to allow the credit that was on your 23 return to be used to calculate the penalties for 24. So we shouldn't have penalties because this credit has been eliminated, but you should be prepared to write a big check or a bigger check at tax time, because that credit's not going to be there, and we've built that into the estimates and our withholdings and all of those other things. And so now the check that you're going to write is bigger. You're going to get the trade-off of writing a smaller check to the county for the real estate taxes that you pay in 25, but we're going to have that shift. So it's something to pay attention to. And we'll get into this, the pass-through entity tax here in a second, but we were using a lot of property tax credits in those partnerships and S corps to make the PTET payment. And since that's going to be gone, then we're going to have to write the check for the pass-through entity tax. So let's talk about that just a second. Again, not new, because this was new last year, but it also came out about this. We finally got rules about this time last year on this. And so it was fairly new for a lot of tax preparers. So depending on what your preparer did, it's may be news and it may not be, and it's always a good reminder. So and it gets confusing because the property tax credit gets, abbreviated to PTCs, and this is the PTET, and all of them just gets rather confusing. But so this is pass-through entity tax election. This was put into place to work around the state and local tax deduction limitation for itemized deductions that Congress put in place with the Tax Cuts and Jobs Act back in 2018. So at that time, they said you can't deduct more than $10,000 in state and local taxes on your itemized deductions. So a lot of states, especially the high tax states, did not like that. They wanted to be able to still give their taxpayers a break. And so they started this pass-through entity tax election. Nebraska was one of the last states to do this. But we have it. And what it is it allows S corps and partnerships to pay the state income tax for its owners and claim it as a federal tax deduction. So it kind of just takes that state income tax off of the itemized deductions and moves it to sorry, totally lost my train of thought. Moves it to the corporate or partnership level instead of the individual level, which then qualifies it for a federal deduction. So rather complex topic really, but essentially it comes down to the entity gets that federal tax deduction in the year that they're paid, because they're going to be a cash basis taxpayer. That creates a refundable state tax credit that gets reported on your K-1. So the partnership pays it on your K-1. There shows up a PTET credit, and then you can claim that on your return and you get the money back. So essentially what it comes down to from the state standpoint is the state acts as a filter. The partnership or the S corp pays it in and gives it to the state. The state then turns around and gives it back to you. In exchange for that cash exchange, which that's all. The state doesn't keep any of it. It just moves from the entity level to the individual level through the state. And the trade-off is we get to deduct it on the federal return. It's an add back on the state, so we don't get a state deduction for it at all. Won't change anything there. It just filters it through the state so that we can get that federal deduction. We did have a estimated tax penalty relief for 23, but starting in 24, if we choose to do the PTET election, then we have to have our estimated tax penalties covered. So, and we don't have qualified farm partnerships and S corps, so there is no March 1st deadline, no January 15th estimate allowed. It has to be quarterly taxes paid. We were using the property tax credit to eliminate the need for a lot of people to pay quarterly estimates, but that is now no longer an option. And a thing that maybe again you might have heard about the PTET as a 23 thing, but there was also the retroactive decision. Nebraska and Colorado are the only states to allow that retroactive election back to 18, and we have until the end of next year to make that decision. Our practice went through as just a standard. Most of them were done. We went ahead and made that election, got it done and taken care of in last year's return. But you do have until next year to do it. And you can do a couple years at a time because it can create a cash flow issue if you've got a fairly profitable entity that would owe a lot of tax, and then we got to wait to get it back from the state. And the state is behind in getting that information back. So we have a lot of entities this year that were filed in February and March, and we still don't have those refunds issued back to all the individuals. And so it's definitely something that the state is working on and figuring out. It just is a huge change and a huge ask for them to figure that out in a very short amount of time. So we do have that potential cash flow issue, but we haven't had any trouble not getting income payments back. It's just taking longer than we expected. So, and just a side note that in 2018, Nebraska didn't require a state tax return to be filed if all the owners lived in Nebraska. And so if you're going to make this election for 2018, we're probably going to need to send them a copy of that tax return so that they have it. Otherwise, they have nothing to go off of. So just to give you, again, the savings of this is going to depend on your federal income tax bracket. So if you have, 6 partners in a partnership and they're all in different brackets, it could affect them all differently. And it could be of no benefit to some, and it could be of high benefit to others, depending on their federal tax level. So I put together just an example, assuming a 22% tax rate from the federal, and by the time we added up, excited, and I did some varying dollar amounts so that you could kind of see if you even pick any one of those as to what level we're going to potentially save. So it's probably going to be a couple thousand a year for most entities, but add that up over time and it starts to become a significant savings. So, and again, it's a tax savings that doesn't actually cost you anything other than maybe some time value of the money that the state's got your money. And then the other thing that's going to affect all of this is that the state, so the tax that the entities pay is at the highest federal, or the highest state rate, which has been the 6.64%. They last year changed the rates going forward, so you can kind of get an idea of what's happening to those brackets. So currently we have 4 brackets with Nebraska, and we're working on moving that down to 3 brackets and moving the highest rate, which was 6.84%, down to 3.99%. So you can see over time that the amount of tax is going to go down. And as we pay less state tax, the PTET tax could be less beneficial. And we could, that is an annual election to make that PTET. So when we get to 2026 and the Tax Cuts and Jobs Act rules, including that SALT limitation, expire, maybe the PTET is going to be less right for a lot more people. It's just really going to depend on your individual situation. So it's going to be something that you definitely want to have a discussion with your tax preparer about. Okay, let's switch gears just slightly here and talk about some things that are going away. So I talked about this last year too, but I think, until we hit January 1st of 2026 or Congress changes things, this is something that is going to be coming down the road that is going to be incredibly impactful. So currently, and I know it feels like we pay a lot of taxes today, but I wanted to go back and just throw some previous tax brackets up there. And so you can see back in 1981, I can't even count off the top of my head how many tax brackets there were. There was a lot. And you can see it at the top was 70%. So, and I indexed that for inflation up to today. So essentially what that means is somebody that was making the equivalent of $750,000 was giving anything over that, 70% of it was going to taxes. That makes even what we'll go back to at a 40% rate seem pretty cheap. And you can see then 86 was the next time we had a fairly major tax reform. That was our last, I mean, prior to the Tax Cuts and Jobs Act, that was our biggest tax reform year. And where we had a 50% tax rate, anybody making more than what would be $500,000 today. And then I have 2017 up there, which was again right prior to the Tax Cuts and Jobs Act. And those would have been the brackets and that we would have had before this change. Now, let me explain what I've got, because I got a lot of numbers on the screen. I apologize. The blue, the square is what, if I took those 2017 numbers and indexed them for inflation so that like we could see what those brackets might be if the Tax Cuts and Jobs Act wasn't there. And then underneath that, I have the actual tax brackets for the 2024 year. Okay, so if the Tax Cuts and Jobs Act is allowed to expire, we will go back to something that's similar to those blue boxes, the blue box. So our 37% tax rate, highest tax rate today, that kicks in at 700,000, would move to 40, and it would, or 39.6. I don't know who came up with that number. And it would kick in about 600,000. So the brackets get smaller and the tax rates increase. The only one that wouldn't be very different would be that 10% bracket. That's pretty much was unchanged. And so those ones are not so big. So that is certainly part of the Tax Cuts and Jobs Act that will expire. I think the part that's more significant to farm producers is the elimination of 199A, which is the qualified business income deduction. What that's given us since 2018 is 20% of your qualified business income is excluded from being taxable. So basically you make $100,000 on Schedule F, the first 20,000 you're not paying income tax on. Okay, that's a huge benefit that we don't see really very clearly on the tax return. And so it's going to be something that's important. Like I said, this is included in that law. Like many of the Tax Cuts and Jobs Act, they sunset at the end of 2025. So we have it in law for 24 and then next year, and then this is gone. There is a limitation if your income is too high. So right now, if you're married filing joint and your income is about 385,000 and between 385 and 485, there's a phase out, and then there's some other calculations we can do to get this deduction back. But it gets a little bit more complicated after that. So I went ahead and just put together a comparison just to show you that same, if we just had, the only income you had was $100,000 on Schedule F. And with the old rules, and again, I use those index for inflation brackets to calculate the 2017, 2026 column. So today, if you had $100,000 of farm income, we take that 20,000 QBI, that qualified business income deduction off of that. The standard deduction right now is almost 30 for a married filing joint couple. We have no personal exemptions. So your taxable income would be 50, and at those tax rates would be at 5,600. In 2026, we'll have that lower standard deduction, but we'll bring the personal exemptions back. But even with that, and without the QBI, our taxable income would be closer to 83,000. So the tax due would be about 11. Now this is just income taxes. Your Social Security taxes would be another, $14,000 on that if you were on a Schedule F, but that's not changing. So I didn't put that as part of this calculation. Okay, but the income taxes alone could easily double with the elimination of the Tax Cuts and Jobs Act. Okay, other things that were in there that are expiring, because it was a really sweeping bill. There's lots of stuff in there. Some of it expires and some of it was made permanent. So things that are expiring that we need to talk about is the federal estate tax exclusion. In 2024, we're at 13.61 million per person. So that means a married couple would be able to have an exclusion close to $27 million without paying any estate taxes today. That is gone up to like just under 14 million. They could have rounded right there and made it a little easier for us, but it's 13.99 million for 2025. In 2026, it will go back to the pre-rates, which was 5 million index for inflation. So, and they made it 10 million an index for inflation. So I think it's pretty safe to say we'd be somewhere in that $7 million range, plus another year of inflation. So we might be at 7.5 per person in 2026. Now, when we got the $5 million exclusion index for inflation, it really made a lot of people happy. And we were like, that's great. We've got it. You know, this is good. Then they gave us 10 million and now 5 doesn't look so great. Right. And so it's certainly a drop, but we'd still be close to that 14 to 15 million that a married couple could pass on free from estate tax. And by the time we use some, strategies of minority interest discounts and special use valuations and other things, we probably could easily get a $20 million estate through federal estate tax purposes without paying any estate taxes. So we're still talking about a reasonably good number, but it's definitely something to pay attention to if your net worth is in that 15 to 20 million range. Definitely need to be paying attention to that. Like I said, the standard deduction would be set to go back. So they pretty much doubled it. And again, it's all these old rules that were there in 17 are indexing for inflation behind the scenes. So we'd probably be somewhere in the middle of, somewhere around 15,000 on a married filing joint standard deduction. But the trade-off is those personal exemptions would come back. So we haven't had to worry about those for a few years. And then the child tax credit will drop as well. So if you've got kids under the age of 17, that credit that you'd be getting would also drop in half. So lots of things changing there. The things that wouldn't change is the corporate rate that they made a flat 21%. That was a permanent change. So there is no expiration on that. Obviously, there's lots of discussion already of changing that. So any tax law that we talk about as permanent is only permanent until Congress changes it. But there are other things like these that will change even if they don't do anything. Okay, so those are our sunset rules. Usually this time of year, we've got lots of questions about depreciation. So those are also part changes in the Tax Cuts and Jobs Act. They were enhanced significantly, or the Section 179 was. That was a permanent one. So that's still just going to sit around there indexing for inflation. So in 24, we're at 1.22 million of expense, as long as you don't purchase more than $3 million worth of assets. And that kind of sounds like a lot, but again, we're talking about, a tractor, a sprayer, and a combine, and now we're out of the purchase limit. And so with the rapid increase in farm equipment costs, we certainly have a lot there. And then bonus depreciation is set to go down. So we're at 60% this year, 40% next year, and so our over the top our arching, safety net of extra depreciation is going away. Lots of talk last first part of the year about extending that. Didn't get anything done, and I haven't heard anything in quite a while on that. I'm not going to spend a lot of time. I left this slide here, and I will get the slides to Ryan so he can share those with anybody who's interested. But for anybody who's trading a lot of equipment on a regular basis, maybe using those multi-unit discounts, that's certainly impacting the depreciation. They probably would have felt that in 23 and will continue to feel that on an increasing basis as bonus goes away. So just be prepared, or just watch for that. Also it brings up, as we talk about limiting depreciation, leases become a bigger conversation. So I just want everybody to be aware that IRS's definition of a lease is a little different than what a lot of the leases that are out there. So IRS says that a lease will not is defined by fair market value. It's defined by a fair market value buyout at the end. So if there's a dollar buyout or a final payment buyout, those are not leases in IRS's. Those are just purchase agreements that are disguised as a lease. And if there's an interest rate tied to the agreement, IRS says that is not a lease, it is a purchase. So we just need to make sure that we're really careful in using that as a way to get that deduction today by making a lease payment rather than a purchase. So always a good time to step back and remember the rules for prepaids. So these haven't changed. Just a refresher that you can only prepay up to 50% of your usual business expenses. That doesn't mean you can't prepay 100% of your seed bill. It just 50% of your Schedule F expenses. And that prepaids have to be an actual purchase. You have to give a specific quantity at a specific price. You cannot give the co-op a $20,000 check, say put it on my account, and call that a prepay. You have to buy so many gallons of fuel at this price. You have to buy chemical, a specific chemical at a specific price in order for it to be an actual purchase. So that is going to be one of the things that audit that they're going to look for, is that receipt that shows that you bought something and not a deposit. You also have to have a management reason for that prepay, and that reason can't be tax avoidance. So it's usually not too hard. There's discounts for prepaying early. If you think that there's going to be a lack of supply of that item, or you think the price is going up, any of those are easy management reasons for why you would do a prepay that is not tax related. And then it can't be a dealer financed input. So you can't go to your local feed store and prepay there. There needs to be a separate financing company for that. So again, need to have a legally binding agreement in place. And then as interest rates have gone up, I just think it's important that we take a step back and remember that as we do prepays, that the cost of carrying that expense on your operating note for a longer period of time has gotten more expensive in the last couple of years. So we need to factor that into our decision as to whether or not prepaying is the right choice either. Okay, let's look at a couple other things. Again, crop insurance, nothing new there. Just a few rules that we got to follow. So you have to be a cash basis taxpayer. That's usually not a problem. Most of farm tax returns are filed on a cash basis. You do have to usually sell more than 50% of your crop in the year following production, which means that you has to be your normal practice to sell your crop in the following year. Okay. And you also can't do so we can't say you got your 23 crop insurance in January of 24. I can't defer that to 25 because you've already deferred that a year. So we do have to pay attention to the fact that the law for crop insurance says that it is due to crop damage. So if we're going to have revenue price loss this year, which is likely with the spring prices we had on crop insurance, we're going to have to separate out what that revenue portion was and recognize that in the year that you received the insurance and defer only that which would be due to crop damage. So, and the other thing that's always hard to remember is this is an all or none election. So if you have corn and beans that you both get crop insurance for, you normally sell your beans in the year of production and the corn the year following. We still have to defer both corn and beans insurance. Or none of it. So we can't have a little bit, can't pick and choose. And the other thing that gets confused a lot with crop insurance is that we can take a deposit in December and defer it on paper to January, but we cannot take a payment that was received in January and bring it back into the previous tax year. So that election doesn't work. So, all right, and I'm not going to spend a ton of time on the livestock deferral rules just because we haven't had as much drought this year. But there are two options. There's a 1-year deferral for all livestock and a 4-year deferral for draft dairy and breeding livestock. Again, you have to be a cash basis taxpayer and farming has to be your primary business. The thing that is a little different is that for the 4-year deferral, you are going to have a county disaster declaration. So again, I'm going to just throw up a couple things to compare these two. So again, different things. But with the 1-year deferral, you can't, if you can have another way to prove that the sale was caused by drought, you don't have to have that federal disaster declaration. So if there was CRP released for grazing, there was emergency roadside haying, anything like that would qualify as proof of drought. But for the 4-year deferral, you do have to have a disaster declaration. And so we have those issues. Again, I'm not gonna spend a whole lot of time on that. I just thought this was great. I put this one in last year's presentation. Significant widespread drought in 23. This is the most recent drought declaration map. And we have 10 continuous counties that would qualify for that federal disaster declaration. Last year, we only had 4 counties that did not qualify. And we've switched that to 10 that are qualifying based on the drought in Kansas. And so very different year as we're talking about that disaster declaration. So, okay, a couple more general things. I think that we need to pay attention to this year specifically. So this is, we do, in addition to tax work, we do the financial analysis and create averages from that. And this is the trend from our average net farm income for the last 10 years. And it's been quite the run as we went through some really low years and then saw the profitability in 21 and 22 just spike out of nowhere and then fall off completely again. And I think one thing that's important here is that we're going to have another low income year. And it feels weird to have to pay taxes in a year when you didn't make much money. But we have to remember that in probably 20, 21, and 22, we had incomes much higher than what we were recognizing on the tax return. And from a cash standpoint, it's going to take a little bit for that to work itself through. And because, sorry about that, we have some construction going on, and I thought maybe we're going to get through the whole hour without any major noise, but hopefully that's the end of it. And the other thing that's going to be real important as we think about, not so lucky. I was going to say, maybe I can stop for a second. Yeah, well, if you've got questions, we can throw those in the chat too, and I'll happy to answer those as we get to the end, or if we get another construction break. But what I was saying was it's important to conserve that liquidity as we go forward. This was I went back a little farther in our trend to look at a working capital gross revenue, because we had those sustained profitability years through 2012. And then you can see how quickly liquidity fell off. And I think as we see that improvement again, you can already see that things dropped off quite a bit in 23. I would expect another drop in 24. It chose just the wrong time to do work right outside my office. I think it's important that we try and conserve that so we don't end up back in that 18 to 19 range if we can avoid it. Okay, so one of the things that which seems weird is I think it's important that paying taxes can actually help us conserve liquidity, which sounds backwards. But if you're trying to reduce income by paying things that you don't need, you're actually hurting your liquidity. So maybe we can walk through this example real quick here. So if you recognize an extra 100,000 of income tax or income, depending on your bracket, it could be more than that, but it could be at 20,000 in tax. That's that 5,000 in income taxes, another 14,000 in self-employment taxes. So if you do that, you pay the 20,000 in tax, you're going to have 80,000 of cash available that you can use to reduce your debt. At 7% interest, which is pretty cheap interest right now, that's going to save you $5,600 of interest cost this year as well. So in addition to having less debt, you're going to have less interest for the next year. Or you could have invested it, maybe made $3,200 in a year if you'd invested it at 4%. On the flip side, if you buy something that you don't need, you're going to spend 100,000, so you won't have that 20,000 in tax, but your cash flow is going to be reduced by 100,000. So if you're borrowing another 100,000 at 7% interest, we're going to have an additional cost of 7,000. So you're going to be borrowing more money. If you continue to do that year after year, that just continues to grow. Same thing can happen with finance purchase. You know, we could say, okay, well, I'm just going to buy it and we're going to put it on a loan and then it's not out of my cash flow. Well, we're still borrowing the money. And as we rob that depreciation, if that's what we're using to reduce taxes, then we got to make payments later, which are not, we have to generate taxable income in order to make those payments in the future. And sometimes that can snowball. So I just did a chart matching 7 or 8 years of depreciation versus a 7-year loan amortized over that 7 years. And you can see that the principal and the depreciation match up pretty closely, so that as the cash goes out to make that principal payment, you have a tax deduction to match up with that. When we're using 179 and bonus on financed assets, it ends up looking like this, where we take all that depreciation in year one, and then we've got to come up with cash to make the tax payment later when you're already spending the cash ongoing to the principal payment. Okay. And then it takes about 25,000 in taxable income in order to come up with a $17,000 payment, because we got to have enough cash to pay the taxes at that time, as well as make that principal payment. And it's pretty easy to say, okay, well, I'll just buy another asset, right? And so next year we just buy another asset, but then our principal payment requirements in those future years doubles. And we do it again, and all of a sudden now we're up to 50,000 a year in that year 7 that we've got to cover principal payments. And if profitability doesn't come back around, we're not going to have the money to make those payments. And we've already used the depreciation, and so that creates an issue. All right, we can also do the same thing with prepaids. I'm not going to get into it, a whole lot here, but the more you prepay, the more you've taken expenses from next year, and then we'll have to prepay more the next year to get back into that same spot until we get to a year where we don't make any money. One thing that isn't going to help this year's tax planning is gifting grain, but it's a good strategy to use in a long-term plan. Because it allows us to reduce, especially if you're filing a Schedule F, because it allows us to reduce the self-employment taxes, and we don't have to use that Schedule A to do the itemized deductions to get the charitable donations. One thing that we've seen again since the Tax Cuts and Jobs Act that kind of goes hand in hand with that is a more use of a donor advised fund. They're not new. They've just been used more now that we have less people itemizing because of the state income tax deduction limit. But what this is it's a charitable investment account that allows you to put assets in there, and then you recommend where that money goes. And you can say when it goes there, and so you have control. Typically, people are putting cash in there, and you get that charitable deduction for the cash today, and then you itemize this year. And then you can go back to using the standard deduction and get a little bit better benefit that way. You can spread that payment over to the charities as many years as you want. It's not great for somebody that you're going to give $20 to because you got to go to the investment company, get the money, get a check from them. So it works better. But you could have them schedule a monthly payment to your church or some of those kinds of things. The thing that's kind of great for farmers is active farmers can contribute grain to that. Again, we're avoiding Schedule A altogether and reducing that self-employment taxes. It's also kind of a great plan that works when things are really going well and you have a lot of income and don't want to recognize that. But in years when things are slow and we don't have as much income, your charitable giving doesn't have to drop off. So it's a cool strategy that works in the right situation. I've talked about paying spouses before, but again, it's a nice way to get a few benefits. Traditionally, we've used this to turn health insurance into a farm expense, reduce self-employment taxes. The benefit to that depends on where your tax bracket is. If you're below the self-employment tax limit, that's a pretty good savings. But as you get above that and we're not able to not paying as much self-employment taxes, then the benefit goes away. I do think it's important to just point out that if you're going to the exchange and getting a health insurance policy that's eligible for the premium tax credit, we can't do this as a paying the spouse option, because when you're going there and getting that premium tax credit, you're saying that you've been offered insurance from your employer, or that it's unaffordable what you've been offered. And so if we say that if you go to the exchange and get your health insurance, get a big premium tax credit, we cannot turn around and provide that as a spouse, because now we've created an employer relationship where you're getting health insurance, therefore making you ineligible for the premium tax credit. So just watch how that plays into that. The other benefit for paying spouses, especially for younger couples with kids at home, is just that Social Security history. So if both spouses are not working, not being employed off the farm, it's really important that we're getting a Social Security history built for both spouses. And so paying a spouse, even if we're not going to do the health insurance thing, might be very important as long as you've got kids under the age of 18 at home, so that you can qualify for disability, or they would qualify for survivor benefits if something happened to you. So, and then the last thing I have is just, I guess I have two things. Paying your kids is another great strategy that just works all the time. As long as you're a sole proprietor and the kids are under the age of 18, you don't have to pay the employment taxes for them. They have a standard deduction, about 13,000 right now, actually 16,000, that they don't have to pay taxes on the first 16,000 of income. And so that works really well. And it also creates earned income for them so that they can contribute to a Roth, which is a great higher education savings tool, because those are not looked at for FAFSA purposes the way a 529 plan would be, as ability to pay. And so great strategy, as long as your kids are able to work. Can't pay that newborn to haul out pipe and pay them 16,000 a year. That's not going to fly. They need to be able to definitely do the work, but you can certainly pay your kids for the work that they're doing. And then the last thing I have is commodity wages. And I just say it's a good strategy. Again, something that you need to talk with your tax preparer about, because you want to make sure that that's done correctly, or it doesn't do you any good. But it is a way that we can get wages paid that are not subject to self-employment taxes. There might be some really good strategies if you're an S Corp owner, and we've been trying to keep your wage low to save those self-employment taxes. And now that we need to pay a more reasonable wage that's higher, this can be considered part of that reasonable wage without self-employment taxes. So I feel like I kind of ran through a lot of information there very quickly. But if there's any questions, I think we have time to answer those.
Yes, it looks like there is one. Would it be beneficial to wait until 2025 to pay real estate taxes for 2024? Under what scenario would it be wise to pay the 2024 taxes in 2024?
Yeah, so from a credit standpoint, it's not going to matter. So when you get your statement in December that shows what your property tax credits are, or your property taxes, there's going to be a line on there for a property tax credit. So whether you pay it in December, you pay it in April and September, it's not going to change what you owe. The only strategy that if we could go back 9 months and pay your 23 taxes in 23, we maybe could have gotten a better credit. And otherwise, going forward, there's really no strategy.
Okay. Along those lines, well, I see also there's a question about if the slides will be, yes, usually if you go to the archives on our webinars, and if Tina has shared the slides, those are usually on our CAP website under the archive webinars. So you can go back and look at any of our webinars and take a look at those. But I was going to ask regarding the Nebraska tax real estate credits again, is that, yes, they talked about that in the special session, and that's, it kind of surprised me about the, kind of how things are changing going forward with that. But is it your understanding that we're still talking about 30% credit for like schools and 55% credit for community colleges?
I believe they left the 30% for K-12 the same, but the community college went from 55% to 100%.
And that is for what we pay in 24?
Right.
Okay.
But The K-12 will be 30% of what you're gonna probably pay in 25. And there
Okay.
won't actually be a credit on the taxes that you paid in 24.
Yeah, okay, okay. That's, yeah, that's good to know.
Yeah.
All right. So, and also, a question about the donor advised fund that you mentioned, that, who helps set those up? Is it a financial advisor?
Yep, yep. So a Fidelity and Edward Jones, anybody like that. Most of those companies have the ability to do those things. Yep.
And you could designate, again, any charitable organization. Let's say you pay, 10,000 or so to your church. Would that be eligible?
Yep, you can just call them up and say, send a check to this charity for 10,000, or you could say, send them $1,000 check a month.
Mhm, mhm.
Any of those kinds of things. And again, it's going to depend a little bit on that financial company, but what I've seen is that sort of flexibility, and they could get you a $20 check for,
Okay.
a small thing, but that's probably not worth the hassle.
Right, and again, the benefit of that is to do what?
The benefit is you either take the itemized deduction for, several years so that you get the large itemized deduction in 1 year and then take the standard deduction in the past, or in the case of the farm suggestion, you give grain to that grain never shows up on your Schedule F.
Right,
And so we don't have to pay employment tax or self-employment taxes or income taxes on that money. And but you can dole it out slowly, and you don't have to, you can gift a charity grain directly, but then they have to figure out how to sell it and when to sell it and all of those kinds of things. And this way it's all done, and they can go back to just getting a check.
good, good, okay. All right, lots of good information. Let's just take one look here and see if there's any other questions that have come in. I don't see any, so with that, we thank you, Tina, and also thank you to everyone that's joined us today. So a recording of the webinar will be posted at cap.unl.edu along with the slides. And again, you can register for upcoming webinars. Next week, our CAP webinar topic is beef heifer replacement forecast. And so we will, when we close out of the Zoom, you'll get brief evaluation that'll pop up. And we really appreciate if you would take just a minute to fill that out and then let us know what topics of interest you might be interested in for future webinars. So again, thank you for joining us and enjoy the day.